Most traders are stuck in the same 5 destructive patterns, and they don't even realize it. They're addicted to the excitement of trading, constantly seeking that next adrenaline rush. They obsess over their account balance, checking their P&L every few minutes like it's social media. They overtrade, taking every setup that looks remotely decent because they think more trades equals more money. They let losses destroy their confidence and send them into emotional spirals. And worst of all, they're constantly jumping from strategy to strategy, always searching for that magical system that will finally make them profitable. Sound familiar? If you're nodding your head right now, don't worry. These aren't character flaws. They're symptoms of not having the right framework. Because here's what nobody tells you. Becoming profitable isn't about finding the perfect strategy. It's about finding one strategy that naturally eliminates these 5 problems. Today, I'm going to show you exactly that. A trading approach so elegantly simple that it forces you to develop the right habits. A method that makes excitement boring routine. You'll stop checking your balance because you'll trust the process completely. You'll take fewer trades because you'll develop laser-focused selectivity. Losses won't affect you because you'll understand that they're just part of the statistical distribution. And you'll never want another strategy because you'll have found your true edge. I'm about to reveal a scalping method that doesn't rely on any fancy indicators or hours of preparation. It's completely rule-based, and all you need is a simple 3-step checklist before entering any trade. To prove this works across every market condition, I'll walk you through real trade examples on Forex, crypto, and gold. Here's what makes this strategy so powerful. Every week forms the exact same framework. A high that holds liquidity, a low that holds liquidity, a false breakout that collects that liquidity, a retracement back inside, and an expansion towards the opposite side. This happens over and over because the weekly candle is the market's blueprint. It reveals bias, liquidity, direction, and target. So we'll use the range between last week's high and last week's low. The way this system works is when we're scalping on a lower time frame, like the 1-hour chart, we can actually use that weekly range to find potential entry points. To execute this strategy, all it takes is a simple 3-step checklist, which we're going to go through in detail. So, step 1. First thing you want to do is mark the high and low of the last weekly candle. Let me show you exactly how to do this on TradingView. For this example, I'll be using this pair, but honestly, it could be any other market. What does matter is taking that asset you're trading and moving it over to a weekly chart. Once you've done that, all you need is some sort of drawing tool. TradingView has a box tool already built in. Go to the very highest price point, and I mean the highest point you can see, wick included, and connect that with the lowest price point. Just like that. That creates the essence of your range. Now, once you have that done, grab some sort of line or other drawing tool and put a line right in the center of that box. It doesn't have to be perfect, whatever is close will work. So you get that range drawn, previous week high, previous week low, line in the middle. After this, you can switch to a smaller time frame that you prefer. It'll work on 1 minute, 5 minute, 30 minute, 1-hour charts. The range has 3 main components to it: the top part, the bottom part, and the center part. When you draw this range, you are mapping liquidity zones where algorithms actively hunt for orders. The top of the box isn't simply an area full of sellers. It's a zone where long stop losses and breakout buyers are stacked up. Algorithms know there's easy liquidity sitting above those highs. That's exactly why price often pushes up, sweeps the highs, and then moves back inside. The bottom of the box works the same way but in reverse. It's not just an area of strong buyers. It's a zone filled with short stop losses and pending buy orders. Algorithms drop price below the lows to collect liquidity before reversing direction. In the middle, there's no meaningful liquidity stacked, no large clusters of orders, just random participation and emotional trades. That's why price action in the middle feels choppy and unpredictable. So the rules are crystal clear. Number 1, do not buy at the top. Number 2, do not sell at the bottom. Number 3, in the middle of the box, simply do nothing. And here's what most struggling traders don't understand. Taking fewer trades isn't laziness, it's mastery. When you start passing on setups that don't meet your criteria, it feels wrong. It feels like you're missing out. But here's what's actually happening. you've developed pattern recognition deep enough to know the difference between a good setup and a great setup. Great setups make money. Good setups break even. Mediocre setups lose money. Step 2. Once the weekly range is identified, we go down to a lower time frame. I choose the 1 hour time frame to look for scalp setups. The setup we are looking for is when the 1 hour candle closes outside of the range, either the range high or range low. The key here is the candle must fully close outside. Wicks alone don't count. After the breakout, we wait for price to re-enter and close back inside the range again. Once that sequence plays out, we move to step 3, which is our entry. In this example, since price broke the range high, that's a signal to go short. For the stop loss, we place it at the exact high of the breakout move. For the take profit, aim for at least 2 times the stop loss size. And here, price came down and hits the profit target perfectly. Let's look at another example. Here we're on the Bitcoin chart on the 1 hour time frame, and right here we've already got the weekly range marked out. So step 1 is done, we can move to step 2, looking for the trade setup. In this example, we can see that price came down and broke below the range low. Now we wait for price to re-enter and close back inside the range again. Right here, the candle closes back inside, completing step 2. Now we move to step 3, our entry. Since price broke the range low and then re-entered, this is a signal to go long. For the stop loss, we place it at the exact low of the breakout move. For take profit, we set it at 2 times the size of our stop loss. As you can see here, price moves up and hits the take profit target. Now that you understand how the overall strategy works, let's examine some real trade examples across different markets so you can see just how well this strategy performs. Let's start with Forex. I'm displaying this pair on the 1 hour time frame with our weekly candle range already marked. Price broke below the range low, then quickly closed back above, providing our long entry signal. Stop loss positioning at the breakout low, profit target at 2-to-1 risk ratio. Price hits the profit target, delivering a 2R gain. We let the chart run. Here, the 1 hour candle broke above the upper range boundary, then closed back inside. This creates our short signal. Stop loss goes at the range high, take profit at 2 times risk. Price hits the take profit, another 2R result. Subsequently, price dropped below the range low before re-entering inside the range. This provides another long setup. Stop loss at the range low, profit target at double the risk. Price once again hit our target, securing another 2R profit. Price then gave us an additional setup. Closure above the range high followed by re-entry inside the range. This signaled another valid short entry. Stop loss positioned at the range high, profit target at 2-to-1 risk ratio. Price reached the profit target, delivering another 2R result. Later, price created a substantial downward move before re-entering our range. This technically qualifies as a long entry setup. However, the breakout was quite large, which means if we were to place a stop loss at the low, it would be a very large stop loss. For scenarios like this, rather than using the exact low of the range for stop placement, I identify the nearest significant level. In this case, this resistance level provides a logical stop loss location. Profit target remained at 2-to-1 risk ratio. Price achieved the target perfectly, securing another 2R gain. Moving on, price broke below and closed under the range low, but then came back inside. This created another long entry opportunity. Stop loss at the lows, profit target at 2-to-1 ratio. This trade resulted in a loss, hitting our stop loss for a 1R loss. I'm not only going to show you the wins, but also the losses. The reason is because I want to be transparent about the results of this strategy. That same day, price provided another long setup. Stop loss placement at the range low, profit target at double the risk. Price advanced slightly before declining and hitting our stop loss again, another 1R loss. We let the chart run. This created another long entry opportunity. Stop loss at the lows, profit target remained at 2-to-1 risk ratio. This trade resulted in a loss, hitting our stop loss for a 1R loss. Following this, price didn't re-enter the range until the weekly session ended. Let's see the final results. Out of 8 total trades, the strategy produced 5 winning trades and 3 losing trades, generating 7R total profit. This equals approximately 62.5% win rate in the Forex market, an impressive result considering we utilized only the basic version of this methodology. Naturally, more accurate performance assessment requires backtesting across significantly larger sample sizes. I strongly recommend personal testing on broader datasets, but this demonstration illustrates that even the fundamental version of this system can achieve profitability. Let's see how the strategy performs on the crypto market. Here I'm on this pair, weekly chart. To apply the weekly range in the crypto market, it's the exact same process. Find the last weekly candle that's fully formed. Simply draw a line at the high and low of that candle and extend both lines. This is your trading range. Next, go down to the 1 hour time frame to look for setups. Here, price closed above the range high and then back inside. That's a short setup. Stop loss placed at the highs, take profit at 2 times risk. This trade hits the stop loss for a 1 hour loss. Shortly after, price re-entered again, giving another short setup. Stop loss at the highs, take profit at 2 times risk. This time, price hit the take profit target for a 2R gain. Let's let the chart run. Here, price gave another short setup. Stop loss at the highs, take profit at 2 times risk. Price hits the profit target, giving us a 2R gain. But then, price gave yet another short entry. Stop loss at the highs, take profit at 2 times risk. This one ends up profitable, giving us another 2R gain. Then price quickly gave a long setup. Stop loss at the lows, take profit at 2 times risk. Price hits the target, a 2R gain. Later, price gave another long setup. Stop loss is set at the lows, take profit at 2 times risk. And price hits the target again, another 2R gain. After that, price broke above the range and didn't re-enter until the end of the week. Let's see the final results. Out of 6 trades we took on crypto, the strategy gave us 5 wins and only 1 loss, with a total gain of 9R. That's about an 83% win rate on the crypto market, which is a very solid result. Now let's look at how the strategy performs on the gold market. But first, I want to thank our amazing community. I'll be rewarding the most heartfelt comments, because that kind of support is what keeps me going and motivates me to keep creating free content for you. This week's winner is this comment right here. Please reach out to my email to claim your free month of Flux Charts. Now, if you haven't read about Flux Charts yet, this is the platform I use every single day for my trades. It's completely changed how I trade. Flux can run screeners on up to 15 tickers and timeframes at once, so instead of flipping through charts, it tells me exactly where my setups are happening. They have backtesting tools to build custom strategies and test them against years of market data in seconds, so you know if a strategy works before risking any money. Here's the best part. 90% of their indicators are completely free. Plus, you can use Flux Charts even with the free version of TradingView, which is huge because you can use multiple indicators simultaneously, avoiding TradingView's 2 indicator limit. They also host daily live trading classes teaching strategies, risk management, and trading mindset. Can't join live? They have a full library of recordings. Click the link in my description and use this code to discover the fantastic promotion I got for our community. Alright, let's get back to the video. Here I'm on the XAU 1 hour chart and we already have the weekly range marked. Price broke below the range low. After it traded below for a while, it then closed back inside, which means technically this is a valid long setup. Now, since the breakout was too large, we couldn't place the stop loss at the lows. Instead, we can use the nearest key level. In this case, there was an order block here, which we can use to set our stop loss. We then set take profit at 2 times risk. Price then hits the profit target, giving us a 2R gain. Shortly after, price broke above the range high, but closed back inside. This is a short entry. Stop loss at the highs, take profit at 2 times risk. Here, price hits the stop loss, a 1R loss. Then price traded above the range for a while before closing back inside, giving us a short setup. Since the breakout was too large, we instead used a nearby resistance for the stop loss. Take profit is set at 2 times risk. This time, price hits the target, securing a 2R gain. Moving on to the next day, we had the weekly range already marked. Price broke below the range low, then re-entered, which gave a long setup. Stop loss is set at the lows, take profit at 2 times risk. Price hits the target, a 2R gain. Shortly after, price re-entered the range high, giving us a short setup. Stop loss at the highs, take profit at 2 times risk. Price hits the take profit once again, another 2R gain. Then price closed slightly above the range high, and then closed back inside, another short setup. Stop loss at the highs, take profit at 2 times risk. Here, price hits the profit target, securing another 2R gain. After some time, price gave another short setup. We place our stop loss at the highs, take profit at 2 times risk. This time, price hit the stop loss, a 1R loss. Moving on to the next day, price broke above the range high and re-entered, giving a short entry. Stop loss at the highs, take profit at 2 times risk. Price hit the stop loss, a 1R loss. Shortly after, price gave another short setup. Stop loss at the highs, take profit at 2 times risk. Price hit the stop loss again, another 1R loss. But then price re-entered the range once more, giving us another short entry. We place a stop loss at the highs and take profit at 2 times risk. This time, price hits the target, giving us a 2R gain. Let's see the final result. Out of 10 trades we took on gold, the strategy gave us 6 wins and 4 losses, with a total of 8R gain. That equals a 60% win rate, which again are very solid returns. Those results prove that this simple weekly range strategy works extremely well even when traded on different markets. And remember, this was the most basic version of the strategy. We didn't even combine it with other concepts yet, but even then, we still got very solid returns. This is definitely a strategy you could try out for yourself. If I get enough comments asking for it, I'll make a video explaining this strategy with a bonus tip that makes it more advanced and much more precise, allowing you to profit even when price exits the range completely. So, thanks for watching, and I'll see you in the next video.